We're live, Jeff.
All right.
I think there's some typos in there, but we are live. So today's Freedom Workshop is being hosted by Jeff, who has, as I mentioned to those of you who are on the Zoom call, been helping my father and I become Value Builder certified and become Value Builder coaches. It's a new area of focus for my dad and myself to venture more into this sort of advisory role. I think it's a really amazing program. What it's got some amazing tenets that help you be less involved in the business, but yet make the business more scalable, more profitable, and more saleable, which I think is the objective of many of us as business owners who are trying to get the most out of our business. So with that, I'm going to let Jeff take us through the Freedom Workshop, which is really an introduction to what the program is all about.
Awesome. Well, thanks for having me, Andrew. It's exciting to work with you and George. And I'm excited to have the live people here. So Brad's going to make an appearance at QVC. I'm going to nickname you guys Shock and Awe. So Andrew, you're Awe because Andrew Wall Esquire. There's your new nickname. And Brad can be Shock. I don't know why, but Shock and Awe, that's you two. You like to make a splash, make an appearance. So today's workshop is about getting back to why you started your business.
Hi, guys.
As I mentioned, and we're going to work on the freedom to do things your way, to work with who you want, when you want, and the goal is financial freedom. So as you can see, this is one of the rare pictures of me wearing a suit. Andrew, I think, is a suit native, but I don't wear them often, so got to update my profile. Today we're going to cover, I'm going to go through a little introduction, and then we're going to cover the 8 drivers of value in your business. And I'm going to give you some theory, but I also want to give you some practical examples. And then there are some exercises that, depending on time, we'll see if we can get through some of them. But the idea is if we don't get through them, and I assume Andrew will find a way to share slides with people, take note of these exercises and work on them yourself because they are very useful and they can help you with your business. So believe it or not, we're going to get through all of that in the next hour and a bit.
Enter your meeting ID.
And if you have any questions, feel free to use the question box, the Q&A box, or the chat. So first, let's define the owner's trap. And if you recognize any of this, you might get it.
Attendees can now hear you speak. This meeting is being recorded.
There we go. All right. So Andrew, you good?
Yeah, I apologize. I got booted off. Someone tried to call me and I tried to and I accidentally hung up on the call, so I'm back.
It's weird because we could hear you calling in, so you might want to reboot everything.
Yeah, I'm just afraid to do that and mess up the live, so I'm gonna have to just bear with me on whatever's going on.
We'll work through it and have some fun doing it. So the owner's trap, if you recognize this, the key signs are that the business slows when you're away. And if there's a problem, your customers or clients come to you first. And the last sign is that your revenue has reached a plateau. So those are the symptoms of the owner's trap. The owner's trap, what it looks like or what can contribute to it is if you're the only one doing the selling and the delivering and the customer service, and you offer too many products or services. I work with a lot of bookkeepers and accountants, and I'm going to say that most of them are guilty of all of these things. But having said that, this is not an industry-specific problem. I assume, if you're watching this, you're a business owner of some sort. I guarantee you have these challenges. The only ones who seem to get past it are the retail shops. They seem to realize the fewer things we offer, the better we are. But I will say I've been in a restaurant or two where they have a page where they offer Chinese, the next page is Italian, next page is Vietnamese, next page is Filipino. It's like, really, are you good at all of those things? Because to me, those are different. So one of the easiest paths to success, and I'll annotate on this over and over, is to simplify your offering, make it clear. Okay. So this is called the Freedom Workshop, and it's for business owners. And the reason it's the Freedom Workshop is the ultimate freedom is to own a business that is both valuable and sellable. Not saying you're going to sell, but if a business has value, that means for the owner, you're getting more value out of it today. Or, as I said, if there's more value, you have something you could sell. Now, again, not everybody's looking to sell, not everybody wants to sell, but what I see a lot in the accounting space or in a lot of small businesses, the owner has health issues, all of a sudden they're forced to sell. So our goal is to make your business sellable so that it's not dependent on you. And that gives you the freedom to decide if you want, you can scale it so you can grow, you could sell it, always an option, or pass it down to the next generation, or simply run the company as a chairman without you being involved in the day-to-day. All right. So we have 8 drivers. I mentioned that. And as Andrew mentioned, this is based on the Value Builder system. If you get a chance, one of my absolute favorite books is Built to Sell by John Warlow. And that book sort of sparked a little revolution in me, got me to leave my cushy job at Intuit and go back into coaching, because it's all about how do you build that scale into your business. So we start with an assessment, and I'll give you a link if you guys want to try the assessment at the end. Andrew, you can even paste that in the chat box if you like. But with the Value Builder, there is an assessment, and the goal is to improve the value of your business so that you can gain freedom over time, money, and get back to the reasons you started your business in the first place. Through the Value Builder system, over 14,000 businesses, I think that number is way out of date. Last I heard it was about 50,000 businesses since 2012 have figured out how to implement the 8 key drivers in their business. And we're going to work on each driver. I'll explain why the driver is important, and then we're going to give you some tips on how to improve performance in each area. So let's jump in. We're going to start with the financial performance of your business. Now, I know a lot of you are used to boring webinars where you multitask and you zoom in and out. Please don't do that with this one. I promise you, our goal is to give you some practical stuff. Financial performance is the first, and I'm just going to share the buyer's perspective. So if you were to sell your company, a buyer cares about 2 things. And again, we're not talking about you're going to sell. It's just, if we want to run a business, we should consider what others would value in it, because why build a business if we have no desire to build value? So the goal is to build a sellable business, not because you want to, but because owning a sellable business gives you the ultimate freedom. So with the Value Builder, John Warlow is a data guy, and they've analyzed thousands of business sale transactions, and they can say with certainty that a financial buyer only buys a company based on 2 things. One, they're looking at how much profit will your company generate in the future, and secondly, how reliable are those estimates? So they're buying your future stream of profit. So they want to know, are they accurate? And what we're going to talk about, the 8 drivers, it's about how do we increase the profit, which is good for us today, whether we decide to sell or not, and how do we make those numbers more reliable, which, if you don't really get the whole thing about profit, the goal is to reduce our stress financially. Okay. So, Andrew, you, I think you were trying to chat to the attendees. You're just chatting to me. So Technology is not working for Andrew today. All right. So Andrew says hi to everyone. Okay, there we go. So Andrew has put in the chat box a link to the Value Builder score. Whether you want to go further or not, I recommend you get your score. It just lets you know where you are today. And the way the Value Builder system works, you click on the link, you fill out the assessment, and you get a 27-page report, and it'll show you where you rank in each of these 8 drivers. So don't try to fix everything at once. Pick your lowest level driver and work on it. So I'm not going to spend all day talking about future value, present value, all that wonderful stuff, but I want to give you an example. So if we have a financial acquirer, they're going to start by estimating how much profit you'll make in the future, and then they're going to apply their rate of return on that as a discount. So they're committing their capital. They want to get some money back. And let's imagine we have a business that's forecasted to earn $1 million in pre-tax profit next year. And a buyer comes along and wants a 15% return on their money. That buyer would be willing to spend, as you can see, at most $869,570 today for the rights to $1 million a year from now. Basic math, it's 1 million divided by 15%, or you can use 1.15. But that's not the end of the story, because this business, hopefully like your business, expects to make a profit 2 years from now, 3 years from now, etc. So the buyer will again value the second year of profits by applying their expectation for 15% return, but now it's a 2-year wait. So they're going to divide by 1.15 twice, and so on up to, if you had a 10-year business that generates $1 million a year, the net present value, or what they're willing to pay you for that, is about $5 million. Now, if the buyer, on the other hand, has a higher risk expectation, they're going to apply a deep discount. So if they're not convinced that your numbers are certain, or they're not happy with the numbers, they're going to apply this discount, and the exact same business, just based on their assessment of risk, could be valued at just under 2 million instead of over 5 million. So again, I don't want to spend a lot of time on how we calculate value, but the idea is, how can we improve the value of your business? So I'm going to give you a couple of tips. Number one way to improve financial performance is to have really good books and records. So if you're talking to other business owners, the best way is to make sure you know what your books and records look like. The other one is, you want to make sure you have a really good financial advisor, whether it's a great bookkeeper, great accountant, or business coach. You want to work with somebody to make sure your numbers are both reliable and desirable. Now we're going to get into the other 7 drivers, all help with financial performance. So that's why we start with financial performance. Andrew?
Yeah, I think my comments on here is that obviously financial performance is one of the first things that people look at. In the accounting world, we often talk about, function of the top line, 1 times earnings, or, any sort of multiple of earnings is what I think a lot of people talk about. But ultimately, a buyer isn't looking at earnings or gross revenue. They're looking at ultimately what are the function of the future cash flows. What am I going to get out of this business if I buy it? And they're doing a whole bunch of different calculations in their head to figure out what their discount rate is, as far as going, okay, well, can I increase the value? Are there any synergies with my existing practice? But ultimately, the very first thing that people or potential buyers are looking at is obviously the financial performance of your business. So it's got to be one of the key metrics that you focus on. Obviously, we're going to talk about all the other different metrics in the value driver process here, but arguably the most important is revenue for the sale of your business, but also for the ongoing profitability and the day-to-day. Because if you're not ready to sell today, the goal is to put more money in your pocket until the day that you are ready to sell. So I think, clearly financial performance is the key metric. How different buyers will interpret and measure that financial performance is going to be different. But of course, the better it is, the better multiple you're going to get, bottom line.
Absolutely. And as Andrew pointed out, the better it is today, it just means you're making more money. And one of the number one things I see in business, especially smaller businesses, we get stuck at a certain level. We can't grow even though we want to. If we're more profitable, then we can hire more and better staff. So there is a bit of a snowball effect, and it all ties into growth potential, which is the next one. So the second factor is growth potential. And what that means is it's your potential to both scale up and grow in the future. Now, for the record, I recognize that there are people out there who are extremely happy as solopreneurs, and they never want to scale. They never want to have staff. Excuse me. That is okay. But what you want to look at is, even if it's just you're a party of one, how can you make your business as scalable as possible so that you can maximize your revenue? I'm a big fan of hiring the right people to do the right things. Doesn't mean you need a big team. I am the world's largest company of one because whenever I need something done, I outsource that to the right people, get it done by experts instead of me muddling through. So what I want you to do is think about your business in terms of three factors. One is teachable. So how easy is it to teach somebody to do the thing that is your business, whether it's retail, wholesale, manufacturing, service. So how easy is it to teach? So the trifecta of scale, it's got to be teachable. So one of the exercises we're going to do today is growth potential, and we're going to rank your services or products. It's on a scale of 0 to 9. So 0 is not very teachable at all. So for example, it might sound weird, I'll explain it. Not teachable to me is something that takes a long time to perfect. So for example, becoming a CPA is not, in my opinion, for this purpose, teachable, because it takes years to get there. You can teach data entry very quickly. So data entry is highly teachable. So CPA level, or let's say in-depth tax planning, is probably a 0 on the teachable scale. Data entry, not bookkeeping, but just data entry, is a 9. So our goal is we want things to be scalable. They have to be teachable. So we're looking for 9s. We're also looking for things that are valuable, and that's from the customer's perspective. So they get a lot of value out of it. They really appreciate it. They're willing to pay a lot of money for it. Again, tax planning, and there is a trade-off here between teachable, valuable. Tax planning, corporate reorganization, very valuable, not teachable. Data entry, not at all valuable, very teachable. But again, we'll get past the data entry in a second. And then the last factor is repeatable. So something that happens once or rarely is a 0 because it's not happening frequently. We want, ideally, services that are teachable, valuable, repeatable. And one of the challenges I see in a lot of service industries, but in general, business owners find themselves broadening the list of products and services they sell as a customer comes and asks for it. But selling lots of things to a few customers is a recipe for your business to become owner dependent, because you'll be the only person in the company with enough industry knowledge to deliver such a broad product or service line. For example, I mentioned the restaurant with the Italian, Chinese, Filipino, Vietnamese food. That's very, very specific. If they lose their chef, they're out of business, or they have to change the menu. So the secret to scaling is to sell less stuff to more people. So I'm going to give you an example of a photography studio that offers weddings, team photos, corporate events, and school photos. Weddings are not very teachable because you need to have the nuances, understand, you're out in the field, you've got to know lighting conditions in all scenarios. Highly valuable because people value their wedding photos. It's sort of that once in a lifetime memory, but hopefully weddings are not repeatable. If you have a good recurring client, maybe they get married 3-4 times, but most people once or twice and they're done. So weddings get a score of 16. So we rank them and then add them up. Team photos, highly teachable. You just line up the kids, take a picture. Not overly valuable because, honestly, I have kids in sports. We don't send them to the photos. Can be repeatable because every season there's a new team, new pictures. So they score a little better in terms of scalability. Corporate events are less teachable because there's more specific stuff you have to know. Corporations value them. Repeatable is questionable because maybe it's every year, maybe it's not. But school photos, highly teachable. Again, it's very consistent, highly valuable. Parents want them, schools want them, everybody wants them, and highly repeatable. Some schools do it twice a year. Minimum, most schools do it once a year. So there is this element of scalability, and school photos in this example wins.
So I think one thing that's really great to talk about here, Jeff, is when you opened this slide up, you talked about there's a number of people that you encounter who say, I'm happy with where my business is now. I'm not interested in growth. And I think that the thing that makes that such a mute point when we talk about the Value Builder program is, I think the perception is that growth means more work and more effort from them.
Yeah.
And using this structure of finding the teachable, valuable, and repeatable aspects of your business, you can grow and you can scale your business, put more money in your pocket without having to put in more time and energy necessarily from yourself. And so I think, and this is an assumption here, what happens when you make assumptions, you make an ass out of somebody. But the assumption, I think, is that if you want to grow, it's going to be at the expense of your work-life balance. And I think that the key of the Value Builder program and what you're talking about here about, identifying the products or services that you offer that are teachable, valuable, and repeatable is driving those aspects of your business that are going to allow you to grow and scale, but not require huge commitments from you. And I know, knowing what's coming down the line, I know that that's one of the things we're going to be talking about later on the slide. So I won't steal too much of your thunder, but I just want to point out that aspect between where you started out and obviously where this program is going.
Well, that's great insight. Thanks for sharing that, Andrew, because that is very true. A lot of people hear the word growth and they tune out and they think, oh, this isn't for me. But the reality is growth is so much more than more work. I look at it, I actually have another presentation, which we're not going to get to today, but it's how do you earn twice as much with half the stress? Growth is not about working more. It's not just about working more. It's about working smarter. And I know that's an old cliche, but work smarter, not harder. So for example, I deal with a lot of professionals that are working 80-hour weeks. The reason is they're trying to do all of these things. Now, if you pick one and you get really good at it, you can scale it, you can improve your efficiencies on it, you can create processes around it. It's really hard to scale if you're trying to do everything for everybody.
Now,
So,
I got to interrupt with a joke I heard the other night that you just reminded me of. You know what the definition of an entrepreneur is?
What?
Someone who works 80 hours a week to avoid working 40 hours a week.
Yes, and that is it's funny but
unfortunately true.
That's yeah, I can relate. I've been there, done that. I am not employable and I'll work really hard to avoid having to get a job. But if you think about any business out there, We all get guilty of this. We call it scope creep, whatever it is, but it's really hard to make the money we should. If we're trying to build 4 different things, we should focus on one thing. And I mentioned earlier, there is a trade-off between valuable and teachable. As you work through it in your own business, take this little exercise and do it yourself. You're going to find this tension between valuable and teachable. The least valuable attributes are often the most teachable, whereas the most teachable are the least valuable. So that's normal. And I know a lot of professionals, you don't want to be in a commodity space down here. A lot of people, they'll take extra classes, take more classes, become more specialized so they can charge more. I would argue that your efforts and energy, instead of becoming more specialized, would be better if you could become more scalable.
Yeah. And I think with systems, with the right systems and process, you can create highly teachable products or services, primarily services in what we do. You can teach highly teachable services that still have tremendous value if you have the right systems and processes.
Mm-hmm. Now, if we're talking about, I'm going to use an example for accountants, just because now this is a service industry. Don't think, oh, this is for accountants, I'm going to tune out. But Darren Root is an expert in the accounting industry. He co-wrote E-Myth Accountants with Michael Gerber. And he created, so he did his little stacking, and the corporate finance stuff is very valuable, but not teachable. Technology consulting, audits, they're a little bit more teachable, a little less valuable. And then in the very bottom right, he found a lot of the day-to-day bookkeeping stuff was very teachable, but less valuable. So what he did is he focused his accounting practice on serving the needs of professionals like doctors, architects. He picked a niche, which that's another one of Jeff's rants. We will not go there today. You have to have a niche. There, I went there. They place a high value on their time, these architects and doctors. So what Root decided to do was bundle all of these teachable services, and he created a program. It's called Back Office Support System. And when he bundled them, so he calls it Back Office Support System, BOSS, registered trademark. Basically, he made it look sexy, outsourced the accounting function from business to him. And what he was able to do with that is move these less valuable services by bundling them. He made them very teachable, very scalable, and he focused his practice on these services. So the reality is, if you're focused over here on the valuable but not teachable, you, no matter what you call yourself, you have a job. You just happen to be the boss. You work for a mad person, because you're not going to give yourself time off. You're going to work 80 hours to avoid 40. This is a job, not a business. If you can make it scalable and it runs without you, then it becomes a business. Okay. So think about when you do the rank stacking, if you have a lot of things that aren't very valuable, how could you bundle them so that they are? Now, I'm going to share an example. This is a Canadian one, so I want to share this as well. John Stanton is the founder of The Running Room, and he decided he needed something to set his company apart, and he wanted to focus on offering running clinics in his store. Because originally he was selling gels, apparel, shoes, not very exciting, and it was a commodity. People would go wherever it was cheapest. Now you can see it was very teachable, but not very valuable. So he started running clinics, pardon the pun there. The idea was teach people how to run a 5K race, a 10K, and then when they graduated from there, they went to half marathon and then a full marathon. And ultimately, it was about qualifying for the Boston Marathon. And he made these clinics based on his experience as a runner, and he scaled up his business and opened a second store. Now, fun fact, he actually started out of his garage in Edmonton, Alberta. So little local success. But once he opened the second store, the third store, he taught each of his managers how to run the clinics, and his customers both valued the advice. And once they ran their first 5K, they were hooked, and they'd come back regularly for more clinics. So he knew with certainty the numbers. So many people would go through the basic clinic, they would graduate to the next level, and he scaled up his teach, valuable, and repeatable service wrapper. He now has over 100 stores across North America. Not saying you want to get to that level, but I just want to share that this works for services like accounting, works for products like running shoes. So if you own a product-based business, and if you are an advisor like an accountant or bookkeeper, if you've got clients that own product-based businesses, try to help them identify a service wrapper that adds to the teachable, valuable, repeatable. And for the record, one of my favorite things, I have a few weird favorite things, but one of my favorite things is looking at a business and saying, what could we wrap around this? And so far, I haven't been stumped. The one that challenged me most was realtors, because people come to a realtor, they want to buy or sell a house. What I realized was, yeah, people want to buy or sell a house. People don't necessarily know how to buy a house, don't know how to finance a house. So what if you created home buyer clinics or home seller clinics or homeowner clinics? So I figured out realtors. So put a little thought into it. With accounting space, we have a lot of intellectual property. Why not figure out how to bundle that as a service or a product? Okay, so the first exercise, I want everybody, and we're doing good for time, I want everybody to take a look at how can we rank the products or services that we offer. So you don't have to do this now, but think about how many products or services. So when you're going through this exercise, do it on your own. The things I want you to think about are, how many products or services are you offering? And a little hint, if you need a second sheet of paper, you're offering too many. I think this quote is, "Jack of all trades, master of none." And then go through and rank them, and not saying drop everything or stop doing everything, but take the most scalable one, figure out how to standardize it. Andrew and his dad, George, are huge fans of the ISO certification process. How could you standardize it so that, you know, everybody can do it? One of the most common things I hear from entrepreneurs all across the board, and this is a judgment thing, but I don't think it's bad. They tell me, "Jeff, you don't understand. I can't hire good people. My staff are idiots. They don't get it." The reason they don't get it is, if we go back here, we're trying to get them to deliver high level services where maybe they don't have the skills yet. So if you're going to offer high level services, what parts of it could you standardize? One last comment on this. There's a difference between the decision to do something and the execution of something. I would argue, you know, for example, creating a tax plan, the decisions are important. Once decisions are made, there's basic forms that have to be filled out. You maybe can't train somebody on the decisions without years and years of experience, but you should not have experienced people then filling out the forms. So for everything, there's a decision part, which requires that high level, maybe it's not teachable, but then there's execution parts, which are very teachable.
And I think one of the great things that we talked about, Jeff, when we went through the Value Builder program for ourselves, was combining those highly valuable but less teachable processes with highly teachable but less value processes to create a bundle that meets both of those objectives to really, like the BOSS program that is bundling a whole bunch of things that have varying levels of value versus teachability. And by bundling those together, that's really where you can create that great growth potential. Because I know that when we looked at it too, we're like, geez, a lot of these very teachable processes aren't very valuable. How do we overcome that obstacle? Bundle together the teachable with the valuable, so you can have highly valuable stuff that might require some more senior expertise, but it's a smaller component of the package, so you can still deliver it at scale and at volume.
Absolutely. All right. Now we have George here. George, if you want, we can promote you so you can actually speak too, because you've got great insight here. Now, the next one is the Switzerland structure. So take some time, just write out your services. Again, scale of 0 to 9 for teachable, valuable, repeatable, and your totals, that'll give you areas where you want to focus. Now, the lowest score, just because it's not teachable, doesn't mean you want to get rid of it. But just ask yourself, do I want to scale? And really, if your goal in life is to work less and earn more, you want things that are teachable, valuable, repeatable. If you're okay with working long hours and not making as much as you want, then go for the lowest score. All right. Now, up next, we have the Switzerland structure. And this is named after, obviously, the country of Switzerland. And it's about being neutral or independent. And I would challenge you all to become obsessed with making sure your business is no longer dependent on key customers, suppliers, or employees. So from a customer perspective, your goal should be no one customer makes up more than 15% of your revenue. If they're over 15, then you run into some independence issues or dependency issues where you're going to have to be more dependent on them. I'm not saying fire your biggest clients. My goal would be instead, how do you clone your biggest client so that if they're 20% of your revenue, find another one like them so that your average comes down below 15. And again, a business that has, for example, 10 clients, each bringing in 10% of your revenue, it has more concentration risk, but it's more easily managed. You can reduce your time. Whereas if you have 100 clients that each make up 1%, you're spending more on them in terms of managing them. Now, in terms of suppliers, ideally, you should be able to switch any supplier without significantly hurting your business. Sometimes that's easier said than done. In the accounting space, for example, it's hard to change software, but it's not impossible. So you want to have some backups, redundancies. You don't want your business to be adversely affected by one supplier. And the hardest part of the Switzerland structure is usually employees. And now this is one of the other hats that these entrepreneurs wear. If we are the key employee, we are number one. There's dependency. We want to reduce that. So you're going to hear this over and over and over again. How do we reduce the dependency of the business on us? One of the things I'll say is you can be really good at one thing, doesn't mean you're good at everything. So a lot of business owners try to do all things, but if marketing and sales is not your thing, you should be outsourcing that or hiring somebody to do it rather than you doing it yourself. So how do you reduce the dependency on you as a key employee? Personally, I once had kidney stones that put me in the hospital. I had to have surgery in late April. I was the only person in my practice. I had to file a lot of, had to beg for forgiveness from a lot of clients because their tax returns were late that year. But the other thing was the day of surgery, I was supposed to stay in the hospital for a couple of days. I checked myself out and went back to the office. Not a place I want anybody to be in. And quite frankly, I don't know how good the returns were that week because I was on painkillers. So sometimes you got to learn maybe how do we have redundancy or backup? Okay. So this leads us to exercise 2. And what I want you to do is just do a little stack ranking of your employees. So rank number 1 is the most difficult to replace down to the least difficult. And what you're going to do is, if you are the main producer in your business, you are number 1. So for example, my good friend Andrew Wall, he has a lot of skills. He is too critical to the business. So how can we reduce the business's dependency on Andrew? And one of the answers, which both Andrew and George would probably shout from the rooftops, is systems, processes. So first thing is rank your employees in terms of difficulty to replace. The second thing is think about ways, so brainstorm, how can you minimize your dependence on that most difficult to replace employee? And secondly, how can you keep those employees both loyal and engaged? Andrew, I don't know if you want to share, but I know you guys have a very creative bonus structure for everybody that's participating today. What are some ways you could, other than systems processes, what are some ways you could reduce dependence?
Yeah, well, I think, the key is, it's all about the systems and processes are the starting point. You can't do any of this without that, because that's, going back to, again, that teachability and being able to have trust. But then you've also got to have the ability to monitor systems. So you've got to have your, KPIs or whatever you want to call them, that you use to measure your business, and then reward your team based on those KPIs that you're using to monitor and measure. So for us, we have 3 primary KPIs that we use to measure our practice, which is first and foremost revenue, right? That's a pretty critical component. Secondly is net promoter score, because we can't have people, racking up bills at the sacrifice of customer experience and customer satisfaction. And then the third one for us, which again drives customer satisfaction and also drives revenue, is turnaround time. So those are the 3 KPIs that we measure for our team, and we reward our account managers based on those 3 metrics. So we've got a pretty basic formula that just, takes all 3 of those into account, so that our account managers know, if I'm driving more revenue, if I'm getting more referrals and I'm getting more business, then my bonus is going to go up. If my customer satisfaction goes up, my bonus is going to go up. And if I can do all that while simultaneously increasing the speed and turnaround time, then my bonus is going to go up. So they've got a direct incentive to process more files as quickly as they can, but as accurately as they can, which drives them to want to use the technology and the automation, which, I was having a discussion, with someone the other day about, well, why do we struggle implementing automation when we have a bigger firm? Right? When we're a boarding cloud business and we're starting the practice and it's just us, it's really easy to just be like, okay, I'm going to start using Receipt Bank. I'm going to make sure that when I'm using QuickBooks Online or Xero, that I'm using all the bank rules and all the automation to its fullest extent. But once you start bringing in team members, how do you make sure that they're taking full advantage of that? And yeah, Intuit announced they've got some new tools coming out for you to be able to monitor and measure that. But prior to that, it was really difficult. So how did you do that? Was for us giving incentives to the team members to make sure that they were doing those types of things, giving back value and increasing their own efficiency.
Excellent. George, anything you want to add?
Well, I'd like to add my input. Yeah, I guess this is all fantastic, but you hear so much about systems and processes, but I think most business people don't understand what that means. And I'd just like to encourage them to look at 4 factors for everything that they decide they're going to do. And that's number 1, you have to have a job description of the person that's going to do the work. You have to have work instructions to tell them how to do the work. You have to have flow charts to help you understand the process, and you have to have feedback and review and constant and never-ending improvement generated by the person who does the job and the person for whom the job is done. Okay, that's my philosophy.
Awesome. That's going to be a title of a book, George. Constant, never-ending improvement.
Yeah, I've been preaching it for 35 years.
I'd buy that book. All right. Let's and one of the things I'll point out very quickly, I won't go back to it, but if you look at the growth potential, if you have 20 different products and services, it's going to take you a long time to create all the systems and processes around it. I would start with your most scalable, prioritize that one, and then you can build the time into your day, because it's virtually impossible. A lot of people say, oh, I don't know where to start, so I'm not going to. But pick one. I like to pick one that causes me the most headaches, create the processes around it, get it scalable, and then go from there. All right, so let's jump in to the valuation teeter totter. And I'm going to share with you the world's worst business model, and I'm going to share with you how to get away from it. So this is the valuation teeter totter, and it's named after the playground equipment, the teeter totter. And basically what you need to recognize is that if somebody is going to buy your business, and quite frankly, you living in it, if somebody's buying your business, they have to write 2 checks when they buy it. The first check is to you to get the keys to the business. The second check is to the business itself to cover working capital. Now those 2 checks come from the same pocket. So the more working capital the business needs up front, the less they're willing to pay. So your value will drop. Now, if you can reduce working capital needs, it swings the other way, value will go up. So the goal is to reduce working capital needs. So if we can improve cash flow, it makes it a lot less stressful to run, but it also makes it more valuable. Now, I promised you I'd tell you the worst business model. Stop me if you've heard this one, but there are businesses out there, believe it or not, they will take on a client and they'll work with the client. They'll do a major project for them. They do the work, they pay the fees, they pay their staff, they pay their overhead. Sometimes the project will stretch out for a couple months, 3-4 months. And then at some point they finish, and then the client will eventually pay them for the work that was performed. That is the world of work.
Sounds like the old accounting model.
It's the traditional accounting model. So Andrew spoiled that. That is, ironically, and I laugh at this because these are the business advisors that are advising business out there. They're running traditional accounting practices and bookkeeping as well. We're running on the worst business model possible because we're paying out today and then waiting for money to come in eventually. And one of the number one things I would say, if you want to have a business, and we're going to get to an exercise in a minute, but if you can figure out how to accelerate the cash in and decelerate cash out, that's the number one way you can reduce stress in your business. And I get a lot of pushback, as Andrew said, the accounting space is all about, you get the client's information, you do the work, eventually you get paid. To me, that was a terrible business model. I would really recommend you look at either value pricing, which is a little heavy, but for me, I like fixed pricing, and take it to a model where you're getting paid monthly rather than once a year. Or if you're getting paid up front rather than after the fact. So be very clear on where your cash flows in and out are and when they happen. Number one thing I do when I work with an accounting firm, for example, is how do we eliminate receivables? So this is a very, very valuable exercise. And Andrew and George, I want your feedback on this, but let's brainstorm. We're going to focus on how to get paid faster. I'm going to give you a couple of ideas for how to slow down money going out, but I get less excited about slowing money down going out because it's going to go out eventually. The big thing I can control is speed of cash coming in. So as an example, just to slow down money going out, one of the things you can do is if your vendors don't offer terms, you can reach out and negotiate terms. Another thing you could do is if they don't offer discounts, maybe you want to pay sooner to get the discount, but sometimes they'll give you a net 30 days, pay it on the last day possible, but if you can, pay it by credit card, and then you get another 30 days interest free. So
plus 1% bonus points.
Plus bonus points, yes. Lines of credit, other things. I see a big mistake a lot of times. People will buy long-term capital assets and they'll use operating cash to do it. So if you're buying a long-term asset, why not finance it, pay it out over time? It'll smooth out your cash flow. So let's love to hear your thoughts, guys, but let's think about the more valuable piece. How do we get money in sooner? And
I think
number one is
one of the things. Obviously, one of the big things in the accounting model is either the subscription or monthly billing process. And we've actually been doing that, I think, as long as I've worked with my dad. So I don't think I've ever asked you the question, Dad. What inspired you, and how long ago was it that you moved to monthly billing?
I moved to my monthly billing as soon as I got involved in the accounting business and started to create volume. We went through an incredible growth period when we won the cases on whether a person was an employee or an independent business person, and we were the only people in the game when that started, and so we had to develop a process for managing the cash flow. So I like the idea of annual subscriptions. You figure out with the client what he wants, and you give him packages to select from. And my son taught me the value of giving what he calls Goldilocks pricing. You have 3 packages, and you get them to agree on a package and the yearly goals, and they give them the right to opt out or get out anytime they want without any cost. And you get a monthly payment for what you're planning to do for the year. And at the end of the year, you compare and have constant and never-ending improvement, and that's what keeps the clients happy and the company happy.
Well, and I think you've proven this model. We have never ever had cash flow issues, and our company sits on anywhere from $500,000 and up on what we call pre-receivables, which is prepaid revenue. And I think obviously the accounting model is moving that. We see more and more people doing the subscription model. I think Ron Baker is now moving his concept from value pricing to subscription pricing, and so this is the evolution. And you were doing it, Dad, like I said, decades ahead of the competition. I think one of the things that my dad, I've said this to you many times, is you've been too far ahead of the curve on some of your ideas, but not that one.
What drove me to that was my hatred of banks and how banks treat you. I was never able to successfully deal with them, so I had to develop my own banking strategy.
Well, and again, it's kind of an interesting, I know a lot of accounting firms or professional services in general, and it's funny because the hair salons, restaurants, they've got it figured out. They get paid, the delivery is right next to the payment. But a lot of professional service firms, I had a multi-million-dollar engineering firm. They had a very large line of credit, and they spent most of their time in the line of credit, even though they had millions and millions of dollars in receivables. And it was like, why are you waiting so long to get paid? So one of the ways I would suggest to get paid faster, as Andrew said, is that monthly billing. The easiest one, if you're not ready to make a big change, is billing faster. And this is going to sound really weird, but following up on your receivables. So I'd rather eliminate receivables, but if you do have them, a lot of small business owners don't follow up on them. So you want to make sure you're following up. All right.
And providing easy payment options, I think, is another really critical one. I mean, Intuit's got some amazing stats on how much it improves cash flow by just adding that little button on the bottom of your invoice, pay now by credit card.
Yeah.
And yes, there's a cost to doing that. But it's interesting to hear how many companies just aren't even offering that option. I was actually talking with Matthew Bennett last night, who's now at M&P. M&P, they don't offer payment by credit card. You cannot, that's just not even an option.
Really?
And that, that's saving them the 3%, on the credit card fees. But what's it costing them in interest on the cash flow, right?
Yeah.
So I think that it's a narrow-minded approach, or a myopic approach to, bottom line.
Another thing about the payment plan over a year I found is that the clients like the idea of it being a small purchase and something they can agree to and stop whenever they're not happy. That goes a long way to encouraging people to follow the subscription model, I found.
Yeah, and it's better for relationships. And that, George, is an excellent tie-in to the next. And by the way, if anybody doesn't know this, Driver 5 recurring revenue is my absolute all-time favorite. And I'm going to share 6 models with you. But this, as we talked about earlier in the beginning about financial performance, a financial buyer wants to buy your future stream of profit. And the more reliable you can make your business model, the more valuable your company is. But more importantly, this is not about some hypothetical future buyer. This is about us. If we have better cash flow, it makes our lives easier, less stressful. I know some accountants and bookkeepers that are buying secondhand computers because they don't have the cash flow to buy new ones. And then they spend all their time fixing computers. We're not meant to be computer technicians. We're meant to be doing what we're best at. So I'm going to share some revenue models that are really, really good. And I just want to give you an example first, based on the security industry. Now, this is the security company industry, but it applies across the board pretty much to every industry out there. Numbers will change a little bit, but the concept is the same. In the security industry, there's 2 types of revenue. There's installation revenue. So someone will come to your house, they'll sell you home monitoring equipment, and then they'll install it for a fee. There's the second level is the monitoring, which is type of membership. They charge you a monthly revenue or a monthly fee for monitoring. With the installation, the industry values it at 75 cents on the dollar. With monitoring, the industry values it at 2 times revenue. So if you had $1 million security company and all you did was installation, your company's worth $750,000. Exact same revenue, your company is worth 2.5 times as much. It's worth $2 million. Now, the thing I want you to all think about, and again, I get challenged. People say, "Oh, I can't do recurring revenue in my industry." I've not yet found an industry where we couldn't do something with this. So I want to challenge you to think about your business. How could you create recurring revenue? And I'm going to give you another thing. With an installation type company, every month their revenue starts at 0. They don't know what they're going to do. They have to get out there, they have to hustle, and they have to earn, to get to $1 million, you have to earn about $84,000 a month. So on day 1 of every month, they're at 0, and they got to figure out in that month how to get to 84,000. The problem is their overhead, their expenses doesn't reset to 0 every month. So every month in this model, you're starting in the hole and you have to dig out. That's, again, the traditional accounting model, and quite frankly, pretty much every professional service organization out there. The only ones that have figured it out are lawyers, and you don't talk to a lawyer without a retainer. So think about how you can get money up front, or in the monitoring case, every month, if you're $1 million company, every month, you know that your revenue starts at about 84,000. And yes, you may lose a client or two from last month. So all you have to do is replace the clients that you lose, not start from zero. So which of these two do you think is more stressful to be in as an owner? I would hazard a guess that it's this installation. And there's no coincidence. You make less money, you're less profitable, more stressful, and you have less value to sell at the end. And again, this is an example about a security company, but how can you apply it to your business? All right, now let's jump into, I'm going to share 6 revenue models. So again, this is my favorite model. John Warlow has a book called The Automatic Customer. Highly recommend you read it. And think about, in the book, he actually has, I think, 9 models. But ask yourself, for every one of these, how can I apply this to me? Oh, I just recognized. Okay, I'm going to have to go off. Hold on a second. Sorry, I'm going to have to share this. We have a little bit of the PDF doesn't recognize the stacking. So this is all one slide stack. So let me, hold on just a second. There we go. Sorry, having trouble with monitors. There we go. Okay, so there's 6 versions that we're going to talk about today. So the number 1 version is consumables. So think about coffee. Those that consume coffee tend to be, caffeine is a drug. We tend to be addicts. So companies like Starbucks, they know you're going to come back every day over and over. You know, and I see this in every city I've ever visited. People are walking around with their coffee cups. So how could you create a consumable model where your clients will come back to you more frequently? A more practical example, I see a lot of chiropractors, for example, they're now selling vitamins, mineral supplements, things that people will, you know, if you can create a membership, we're all victims of inertia. So we'll just keep renewing. We'll get to the membership as well. But with consumables, we're creatures of habit. We're not likely to change. So if we make it easy for people to get it from us, they'll just keep coming back. Next, so this is from the 6th most valuable to the number 1. So we're going to get to number 1. Next is something I would call sunk money consumables. So what that means is they spend something up front, and then because they made the investment up front, so Nespresso is a great example, you buy the machine up front and then you refill it. So you're not going to switch to another brand readily, easily, because you've already got the machine. So once you make the decision in your mind to buy an espresso machine, you stop making the decision, do I buy this or that? You're just going to keep buying the espresso pods. So think about this. Again, one of the examples I would use in a professional service firm, you can have a setup fee where you're giving them their system, you're setting them up in the cloud, or you know, setting them up with whatever your tools are. So they put some money in up front, and then you have a monthly renewal fee where they get the actual consumable. Magazine subscriptions is subscription is number 4. Again, this relies on inertia, but could you create a product or service that people will subscribe to and it renews every month so that they can get the value from it? Magazines are the classic example. You know, you get a 12-month subscription and then somewhere around the 11th month, they offer you some deal you can't resist, so you renew. The goal is add some value, but have it regular recurring. So again, as Andrew mentioned with the accounting space, have a subscription model, or, again, any professional service. I've mentioned this to chiropractors, doctors, dentists. Have a subscription where people, can come in for a checkup every month or whatever, but keep them engaged. Now, number 3, sunk money subscriptions. In the Wall Street world, brokers, people who need the data, they subscribe to a service from Bloomberg where they get real-time stock quotes, things like that, reports. It's the industry standard. The sunk money aspect is you have to buy a Bloomberg terminal for tens of thousands of dollars. And what that does is it gives them loyalty, because again, you've spent money on the terminal, you're not going to change easily to something else. Now, Iron Mountain, they have a auto renewal subscription. So they do document management, document storage, and they'll just keep billing you every month until you tell them to stop. So there's no end, there's no begin, it starts and then it doesn't end. So it's a perpetuity concept. Again, this is more valuable because most people will keep renewing over and over. So think about how can you turn this into a renewal subscription. Again, if you have a professional services business, you should be looking at having long-term, no expiry date contracts where you're going to get them to keep coming back over and over. And as Andrew mentioned, it's a lot easier to pay monthly than it is to pay big lump sum once a year. Okay. And the most valuable is long-term contracts. When AT&T released the iPhone originally in the US market, they required a 3-year contract because they knew it would help their stock price, it would help cement the market, and again, it secures long-term clients. Now, we talked about somebody buying your business, they're going to value it more based on the predictability and certainty of your future revenues. A long-term contract guarantees that. So that's the hierarchy. And what I'd like you to do is think about, how does this apply to me? Which of those, and I would argue, again, I haven't been stumped yet, but if I sat down and thought about it, every industry should have at least one of those 6, ideally all 6 if possible. I'm going to give one more example, and then I'll let George and Andrew chime in with any comments they have. There was a restaurant in, I think it was Chicago, that was struggling to survive. They created a monthly membership site, and they actually paired it with a local winery. So for a membership, you got a bottle of wine shipped to your house. No, sorry, it was shipped to the restaurant, and you got a dinner for 2. And so people would come to the restaurant to pick up their wine, and then they'd stay for dinner. And what they found was they were able to turn once in a while customers into repeat customers coming in once a month. They sold more wine, obviously, because people would want to try the wine that they bought. So they'd be taking that bottle home, but they'd open one in the restaurant as well, and they'd purchase it. So they actually changed consumer behavior. So ask yourself, how can you create more favorable conditions? And think about any business you're in. If you have long-term contracts or stable clients, way more valuable than if you're always chasing. And if you're not good at marketing and sales, figure out how to maximize the dollars from your existing clients. George, Andrew, any thoughts?
Yeah, I think that's.
Would you like to go first? Yeah, go ahead. You want to go first? All right, there's a couple of things that I'd like to talk about. And the first one is planning and getting all this together. And I've become a real fan of what I call peer coaching. And so I encourage clients to make peer coaching a part of setting your goals. And once you set the goals and you decide to, the second thing I'd like to talk about is once you've got the goals agreed upon, the first thing you should ask is, does the goal add value? And there are only two ways you can add value, in my opinion. Either increase the revenues more than proportionately, or you decrease costs more than proportionally. So those are the two things you test when it comes in from your peer coaching as to what to do. And if it doesn't pass that test of either adding value by increasing revenue or decreasing costs, you send it back to the peer coaching to get a better answer. Then what you do is follow those 4 guidelines that I spoke about earlier. And I think if you do that, I think you can build a business, and it's a matter of who you surround yourself with and get a good accountant.
Awesome. All right, I'm gonna kick into high gear here so we can finish on time. I don't want to keep anybody late. The next one is monopoly control. And basically this is how different you are in the marketplace. So there's 2 ways to be different. One is you actually have you build a better mousetrap, you're very unique. The other is, how do you market what you do in a unique way so that the market pays attention to you? So the goal is you want to find an attribute or benefit of your product or service that makes it truly stand out in the marketplace, which gives you more control over pricing, which in turn leads to higher margins, which obviously gives you more money for marketing, which allows you to further differentiate. A lot of professional services, they compete on price alone. The good news is, just by figuring out a differentiating strategy, you can start to compete on your own terms. So I'm going to give you an example of Panasonic. They entered the crowded laptop market. And when they first entered, they looked at who was there, who was established. And obviously, Apple was the one people cared that Apple was sexy. Dell owned the direct buy them direct, get delivered to your home market. And HP owned the innovative market. Now, as you can see here, people didn't find innovation very differentiating. You want to find something that's differentiating and people care about. And so what Panasonic did was they looked at what is out there, and they could have tackled any one of these 3 spaces and got in a bloodbath, and all they could do is drop price, and they're going to end up fighting against the big players. So what Panasonic did instead was they came out with the Tough, I think it's called the Tough book, and they said, we're going to avoid price wars. We're going to go after a very unique niche, which in their case was they found customers that cared very much about it and where it was differentiating. So they went after military and police, where they need laptops that can survive out in the field or in a squad car. And so they went after that market space, and they were able to launch the Tough Book brand. And they created what they called the toughest laptop on the market. You can actually throw this thing across a room, not that you want to, but you could, and pick it up and use it. So therefore, they didn't have to compete on price, gave them higher margins, which led to more money, increased their stock value. So they are now the brand of choice for people in rough and tumble environments. So the exercise for monopoly control is just take a few minutes and plot your products and services and think about the extent to which they're different and how much your customers care. So again, sorry, go ahead.
One thing I just want to touch on briefly on this point is, I see, speaking to the accounting and bookkeeping community again, the focus on technology as a differentiator. Technology is not a differentiator. So make sure that you're looking at this from the perspective of your clients and understanding, what truly is a differentiator, and maybe taking this exercise and then sharing it with people to see, is it really a differentiator? because I think a lot of the things that people are putting down as differentiators these days aren't differentiators. Like, I think there's one company that's, we're the accounting firm that cares. Doesn't everybody care, right? Like, so you're going to find an accountant who tells you, I don't care. I don't care about you. I don't.
Yeah, we're the firm that doesn't care. Come to us.
Yeah, we're the firm that doesn't care. I mean, that would be a true differentiator, not maybe in the way you want. But I think that the key is double check what you believe are your differentiators against the market and peers to see if they truly are.
Yeah. Personal service, quality service, timely service. A lot of those are not adding great value. So think about your marketing message and how can you make it more valuable? All right, now we're in number 7, and this is, Andrew mentioned the Net Promoter Score. This is a measure of customer satisfaction, which again is used to help you measure value from your customer's point of view. So the calculations are really simple. You ask your clients one very simple question. On a scale of 0 to 10, how likely are you to recommend our product or service to your friends, family, and colleagues? And you tally the results. A follow-up question might be, why did you score us the way you did? And it's called the Net Promoter Score because anybody who scores you 9 or 10 out of 10 is considered a promoter. Anyone 7 or 8 is considered passive. They're not excited about you. They don't hate you. Anyone less than a 6 is considered a detractor. So the goal of the Net Promoter Score is to figure out your promoters. So in this example, we have 25% promoters minus your 5% detractors. That gives you a Net Promoter Score. So world standard, and this is a metric you should measure every 6 months or so. World standard, world class is anything over 50%. Industry averages are 10 to 15%. So if you're better than 10 to 15%, celebrate. But don't feel bad if you're not up in the cloud with Apple, Amazon, and Samsung. These are the world leaders in Net Promoter Score. And again, because this measures customer satisfaction, a potential buyer is going to want to know how happy are your customers. Now, you can probably get away with not asking these questions and not tracking this. But if you do run the trends and you can show that it's steadily increasing or it's stable, somebody's going to pay you a premium for your business just because you have that little bit of information. All right, last one, last but not least, is the hub and spoke. And this is named after the airline industry where you have hub airports and it works very well. It's very efficient. Regions are dependent on that hub. Most flights come in and out. But if the hub has problems or it gets snowed in, then you have chaos and disaster. Similarly, if you have a business with a hub and spoke manager, and again, this is very, very common, every industry I can think of, the owner is the central hub. All decisions, whether it's dealing with customers, employees, suppliers, go through the owner. That creates a very stressful business because if you take a break, the business takes a break. So hub and spoke is one where you really want to figure out how do we get out of it. And there is a trade-off between profitability and value here. A lot of business owners will try to be more profitable, so they'll hire the cheapest staff they can get. They'll do the work themselves because my time is free. You're going to be way more profitable, but you're less valuable because you're the one doing it. So ironically, if you can hire better employees who can take the work off of you, the business has more value. Because right now, if you're the center and all the decisions, everything comes to you, you have a job, not a business. So if you're maximizing profit, which is great short term, you're taking away from your long-term value. So you want to recognize that conflict between profit and value. And one example I see in a lot of professionals is the owner will do sales to maximize their profit. While you could maximize your value and increase profit over time if you hired an external salesperson. A lot of businesses, they don't hire a management team. The owner who's looking for profit will do it themselves, and they'll hire cheap staff, hopefully, to get things done. It makes you very tactical, not very strategic. So you're going to have short-term profit, but you're never going to get out of that owner's trap. And again, if you can build a profitable business that in the end has no value and it's ultimately worthless. So the last exercise, and then a couple thoughts, we'll wrap up. Brainstorm, what have you done in the last year to make your business less dependent on you personally? So this is where you'd add systems, processes, maybe you outsourced your IT, and then think about 2 actions you could take in the next 90 days to make your business less dependent on you. We're not going to spend any time because I want everybody to finish on time. So I have 2 minutes. I will get you to the finish line, I promise. So just a reminder, the goal of today was to give you some ideas on how you could scale and build that ultimate freedom so that you have a business that can scale, be sold, you could pass it down, or you could run it as the chairperson. Don't just say, that was nice, thanks, Jeff, very entertaining. Take this away and actually do those 5 exercises we shared. How could you actually do that? So Andrew had pasted the link in earlier. This is a short link, but there's 3 steps you guys can take if you want to learn more or to take action. Number 1 is just ask yourself if you'd like to complete the Value Builder assessment. There's no obligation here. Just go to that link. Andrew pasted in the chat box earlier. I'll repaste it. And take the assessment, see where you sit on each of those 8. And again, my advice was pick the one you struggle the most with and solve it. So Andrew, can I leave you to wrap up? I have to pop out. I have another call.
Yeah.
But if I can leave you to run through the assessment or the questions.
Yeah, we just got, I guess, a few, basically the questions you just posted. So I'll post those polls super quick. Looks like we got 100% of the respondents who want to do the Value Builder assessment. And I guess the next question is, who wants to learn more about the Value Builder program? I'm assuming most people want to learn more as well based on that. And again, looks like we're getting 100% success rate. And then the last one is, would you like to discuss how to implement it? So if you want to learn more about that, we can tell you more about that. Bottom line, I guess, one of the things is, I'd love feedback from the attendees of this session, whether you actually found this to be useful or not. We're working, as I said earlier, Jeff's been coaching my dad on the Value Builder program and using this as an implementation tool for our clients and for staffing agencies that we work with. And we're pretty excited about what that's going to do for our client base. But thanks, Brad. Thanks for joining us. I know you got to bail, so thanks. And this is, I think, a really interesting and beneficial tool for the accounting world. As you notice, I started chiming in all the time with, well, how do we look at this and how does this benefit bookkeepers and accountants? And I think that there's a lot of benefits that could really work well for accountants and bookkeepers in this community. So my dad and I are working on developing a boot camp that takes you through the Value Builder program. This is really an introduction to it, but it's really meant to be a coaching program where you go through all the different 8 pillars and you work on strategy and you set tactics and goals and KPIs for how you're going to actually turn your business around to be more profitable. And I think there's something like, I'll get the actual stats and share them with the attendees later, but the Value Builder program, which has been run by hundreds, if not thousands of coaches around the world and was implemented by John Warlow quite a while ago, has actually proven statistically that people who can do the Value Builder score assessment go through the program, do the Value Builder Score assessment at the end, increase their Value Builder Score, get on average 7.1 times more than the people who don't complete the program. And that's looking at true businesses that actually sold, what the real selling price was, what it was as a multiple of their earnings, and they were able to increase their selling price by a multiple of over 7 times. So that's a pretty substantial improvement. Like I say, I think this could be really interesting. If you'd like to learn more about the program we're planning to offer, which is effectively going to be a boot camp. It's going to be a retreat up at the Lindwall compound, which is our family cottage up in the Kawarthas. You might have seen videos of it with some shots that Intuit did for a promo video years ago. We've done some stuff up there in the past if you're following me on social media. So, you know, it's going to be a great sort of retreat, 4 days of getting together, working on your business, going through this boot camp at a fast pace to get those changes and get into the process of managing your business. We're also going to be looking at some stuff on how to become a thought leader, how to ramp up your social media, and we're going to have some fun. We're going to have some drinks, we're going to socialize, and we're going to build a network of people who have share the same vision and share the same goals. It is going to be a fairly limited group because it's a fairly nice place, but we want everyone to be comfortable, so we're not going to be cramming everyone in. We want to make sure everyone has their own bedrooms. So we're limiting this to 5 people that are interested in it. We're going to run it for 2 weeks, so a total of 10 people that will be eligible. I'll be launching more details about that at the after QB Connect probably, and in the new year as we get closer to it. But if you're interested and want to learn more and want to make sure that you get one of those notifications before it goes out to the rest of the world, let me know, because it's definitely going to become first come, first served basis. And on that note, hopefully you guys found this useful. If you do have any questions, post them into the chat. I'll be happy to answer anything now on behalf of Jeff, who's had to run to his next session. But thank you guys for dialing in, and I'll start by maybe killing our live feed.